The first modern stock trading system was created not on Wall Street, but in Amsterdam. The Dutch East India Company raised capital by selling stock and paying dividends of the shares to the investors. Starting in 1611, this was the only trading activity for many years. Once it caught on big. Investors were so excited to buy in that they became a bit reckless, handing over cash in exchange for shares before they even checked the validity of a company. What followed was a series of crashes and bubbles as investors learned the ins and outs of the new system. In America, the first stock exchange opened in Philadelphia in 1790, with the New York Stock Exchange following in 1817. But even the NYSE didn't gain real popularity until the early 1900s. Throughout its relatively short history, the stock market has been the backdrop of both spectacular gains and heartbreaking losses. Today, we're talking trades, specifically the top 10 greatest stock trades of all time. So hit that subscribe button and make sure you stick around for the entire video so you don't miss the largest trade in history. Let's just say it's a very big number. Coming in at number 10, we have Jesse Livermore's $100 million trade. Livermore was a financial genius of the early 1900s and an expert at shorting the market. His first short was luck or an accident. A sale of Union Pacific right before the 1906 earthquake that demolished much of California. He saw $300,000 in profit just 2 days after his trade. But his next short was entirely planned. Livermore noticed that one of his peers, Percy Cotton King Thomas, failed to corner the cotton market and went broke, leaving cotton in a severe bear market. Livermore swooped in, buying up 120,000 bales of cotton. He used a now illegal market manipulation tactic called painting the tape to buy orders at the market close, then selling immediately when the market opened with a higher valuation. Livermore had a few more interesting and profitable trades, but he earned his place on this list in 1929. Livermore noticed that the leading stocks were receiving unsustainable valuation multiples that just didn't make sense. He began probing for weaknesses, selling his long positions and sending small, short bets into the market. He lost about $250,000 doing this, but on the third attempt, he found a narrow opportunity to build a massive short position right before one of the worst days in financial history, Black Tuesday. By the time he collected his profits, Livermore was $100 million richer. The newspapers dubbed him the Great Bear of Wall Street, and he received death threats from the public. Within years, the tactics that allowed Livermore to make his fortune, which ironically he ended up losing, were made illegal, and he was suspended as a member of the Chicago Board of Trade. Today, Livermore's massive short would be worth over $1.7 billion. Moving on to number 9 in our countdown of the greatest stock trades of all time. Paul Tudor Jones's Black Monday short. Jones began his career as a commodities trader in the cotton pits before transitioning to macro trading and founding his hedge fund, Tutor Investment Corporation, in 1980. But his experience with the cotton market and commodity futures with limits made him skilled at noticing overvaluations. So in 1987, when Jones noticed 10-year portfolio insurance rates were at 10.5%, despite the dividend yield on the markets being about 5%, Jones sensed an overcorrection approaching. He and his colleagues at Tutor began looking at historical data to find similarities, using the Elliott wave theory.
I would say I've learned the past 40 years is these, price patterns and price stories. It's the same old story so often, just with different characters, different times, different plots. And so that looked a lot like 1929 to me. And I knew for a fact that if and when it broke, because of the derivative structure, that the downside was going to be unlimited, literally unlimited.
They found a surprising likeness to the 1929 crash, and Jones sold all his stock. When the market crashed on Black Monday, a 22-point drop shattered prior records, and Jones walked away with over $100 million in profit. Jones remains a successful hedge fund manager, handling assets of over $18 billion today. Number 8 on our list made his big trade after watching Paul Tudor Jones short Black Monday. Andy Krieger graduated from Wharton School and worked for the Salomon Brothers before being taken on by Bankers Trust in 1986 for his obvious talent in trading. So reputed was his gift that Bankers Trust allowed him to trade with a limit of $700 million. His peers were nearly all capped at $50 million. In the aftermath of Black Monday, Krieger paid attention to the other currencies that investors were fleeing to. He spotted some that were being significantly overvalued, including the New Zealand dollar, or kiwi. Krieger tried his luck at using the relatively new technique of options to short the kiwi by hundreds of millions of dollars. Krieger's short was so large, many claim it was bigger than the money supply of New Zealand as a whole. New Zealand's government even tried preventing it by calling bankers trust, but the pressure on the kiwi was too much, and other traders fell in line with the short. The kiwi slipped 5%, and Krieger earned a $300 million profit as a result. Today, Krieger remains a successful and influential trader and is also a known philanthropist. The next trade on our list, coming in at number 7, is Louis Bacon's 1990 Iraq War trade. Bacon cut his teeth trading commodities while simultaneously studying for his MBA at Columbia Business School. He didn't turn a profit until his 4th year, but he picked up plenty of valuable lessons along the way. After stints at Bankers Trust and Shearson Lehman Brothers, Bacon formed his own company, Moore Capital Management, in 1990 with $25,000 he had inherited. Shortly afterward, Bacon noticed trends of growing antagonism from Saddam Hussein's regime toward oil-rich Kuwait. Bacon took a chance and traded in macro investments to go long on oil and short on stocks. His company started the year with a fund of about $100 million and experienced an unbelievable return of 86%. Exactly how much Bacon's trade made him remains a mystery, since an exact figure has never been released. Bacon remains notoriously elusive, but continues to be a top trader, returning between 25 and 35% a year. Number 6 on our list of top trades of all time is Jim Chinos, the Enron short seller. Chinos began his career as a short seller and analyst in the 1980s, moving between several firms, including Guilford Securities, before establishing his own hedge fund, Chinos, in 1985. But he didn't gain real notoriety until a phone call set off a series of events that would make him a legend. A friend asked Chinos to look at an article in the Texas Wall Street Journal that detailed the celebrations of the energy companies successfully lobbying the SEC. They wanted the SEC to allow mark-to-model and mark-to-market accounting to be used in their businesses. Mark-to-model gave the companies the ability to take the current value of their future profits and add them into their accounts, a red flag that Chinos spotted right away. Intrigued, Chinos dug deeper and discovered that Enron was using mark-to-market accounting to cook the books and bolster income while hiding losses in their discounted operations. When CEO Jeff Skilling stepped down, Chinos knew something big was about to happen. In November 2000, Enron's stock dipped to $90, with a predicted target price of $130, and Chinos initiated a short. The rest is, as they say, history, and the biggest case of financial fraud Wall Street has ever seen made Chinos and Chinos $500 million in profits. Chinos is still active on Wall Street and has been vocally skeptical of the markets in China, taking aim at Alibaba in a move that has some wondering if he spotted the next Enron. Alright folks, we're coming into the home stretch now. At number 5, we have George Soros and his bet against the British pound. Soros is a truly interesting man, whose personal history began with surviving as a Jewish child in Nazi-occupied Hungary. He moved to England and studied at the London School of Economics before embarking on a decades-long career in the financial markets of the UK and the US, before founding Soros Fund Management in 1970. In 1992, Soros recognized that the rate at which the UK was brought into the European exchange rate mechanism was too high, and that their inflation was triple the German rate. Soros made his move by short-selling more than $10 billion in pounds, profiting from the UK's reluctance to raise interest rates or float the pound. The UK withdrew from the European exchange rate mechanism, resulting in a massive devaluing of the pound by 25% on a day that would be known as Black Wednesday. Soros walked away from the dark day with $1 billion and the moniker, the man who broke the Bank of England. Still a Wall Street icon despite retiring decades ago, 92-year-old Soros is a legendary philanthropist and progressive political cause supporter to the tune of billions of dollars. Number 4 on our list of greatest stock trades of all time is another foreign currency trade, Stanley Druckenmiller's Deutschmark bets. That's right, there are 2 of them. Druckenmiller had been working in financial trading since 1977, but found a kindred spirit in 1988 when he joined George Soros at Quantum. During the fall of the Berlin Wall, markets were severe on the prospects of East and West German reunification. Druckenmiller thought the mark was sitting in a position that was too excessive and began a multi-million-dollar bet on it to rally. Soros threw in his support, increasing their position to $2 billion. Their bet brought in returns of 60%. So when Soros went to battle with the Bank of England, Druckenmiller felt confident to take another stab at the mark. He began by buying up British stocks on the assumption that as the pound dropped, exports would increase. He followed that by buying up German bonds, guessing correctly that others would do the same in the fallout from the pound. His intuition was right again, this time to the tune of an additional $1 billion. The pair of Druckenmiller and Soros worked together until 2000, before parting ways following a series of big losses in the tech market. Druckenmiller formed his own group, but closed it a decade later, citing a high emotional toll. Now he's trading from home atop his personal wealth of $4 billion. Alright, we are officially into the top 3. Next up, Kyle Bass, the real winner of The Big Short, Part 1. Bass started his career working at Prudential Securities and Bear Stearns, rising through the ranks to senior managing director by age 28. In 2001, he joined Legg Mason, advising hedge funds on special situation investment strategies before launching his own firm, Human Capital Management, in 2006 with $33 million in assets under management. After a chance encounter with an investment banker at a wedding in Spain, Bass hired a team of private investigators to check into a point the banker had chatted about: the subprime CDO market. The data his team collected showed that residential mortgage-backed securities were high risk and most likely to default. Bass began purchasing credit default swaps against the securitizations he thought were most unstable as a bet against the subprime mortgage market, and in essence, against the entire financial system. Through his successful prediction of the mortgage market crash, Bass made nearly $4 billion in profit for his hedge fund. Since then, Bass has continued making massive returns for Human Capital and has shifted his focus to national debts. Number 2 in our list of greatest trades of all time is another Big Short winner, John Paulson. Paulson set up his own hedge fund, Paulson & Company, in an office rented from Bear Stearns in 1994 with just $2 million in assets. By 2006, it had expanded to $100 million. But Paulson was still a little-known name on Wall Street. He had his analyst, Paolo Pellegrini, begin to look into the U.S. housing market and backed Dr. Michael Burry at Scion Capital to the tune of $150 million. He then persuaded banks to sell him credit default swaps before settling in to wait. It didn't take long. In 2007, as the market fell apart, Paulson & Company was making over $1 billion a day. By the end of the year, the hedge fund was up by $15 billion. 2008 brought an additional $5 billion, and Paulson himself earned a cool $4 billion. Paulson continues to trade, specializing in event-driven investments. In 2010, he set another hedge fund record by making nearly $5 billion in a single year through investments in the gold sector. And now, what you've all been waiting for. Finally, in the number 1 place for largest trade of all time, we have David Tepper's 2009 bank bet. Tepper started his career at the Treasury Department of Republic Steel in Ohio in 1982, but was quickly recruited by Keystone Mutual Funds and then Goldman Sachs, becoming their head trader within 6 months. He's credited with playing a major role in the survival of Goldman Sachs after the 1987 crash by buying underlying bonds in the institutions that had been crippled by the crash. Despite his success, he was passed over for a partner twice and departed to start his own fund, Appaloosa Management. In 2009, Tepper recognized the possibility of the global financial crisis in a way no one else did. While other investors were pulling away from depressed big bank stocks, Tepper went all in. After reading a government white paper that outlined the plan to shore up the banks, Tepper purchased some of the biggest banks' common stock in huge amounts. It's reported that his firm purchased Citigroup shares at 19 cents and Bank of America shares at 12 cents, along with $1 billion worth of AIG's commercial mortgage securities at 9 cents. Then he watched them double, then triple. Bank of America quadrupled. By the time the dust had settled, Tepper had made $7 billion. He earned $4 million personally and was named Institutional Hedge Fund Manager of the Year for 2009. A lot of research went into this video, so if you enjoyed it or learned something, be sure to hit that like button below and subscribe to our channel for more videos like this. You should watch the video that is being recommended on your screen and check the links in the description below.